All right, in this video, I want to give you some criteria for positional trading. I have discussed screening criteria for swing trading. Let me just take you back to that. So, as a swing trader, okay, these are the things that you should look for. I have made a separate video on this. Focus on the best stocks from the best industry groups, which are in a confirmed stage 2 uptrend, having good institutional demand, tight base on the right side, and which are near their 52-week high. Now, if you notice, these are all technical factors. They have got nothing to do with fundamentals. However, as a position trader, not only do you need those rules which I just showed you for swing traders, but you need additional rules which are fundamental basis, okay, based on fundamentals. And in fundamentals, we only look at four things: sales, earnings, margins, and return on equity. These are the reasons why stock prices go up. There is income statement, there is balance sheet, and there is cash flow statement. Stock prices don't go up because of balance sheet and cash flow statement. Stock prices go up because of sales, earnings, margin expansion, and return on equity. So these are the 4 points that I want to discuss with you here today with an example. So remember, these are the basic criteria. I have made a separate video on this, which says screener for swing traders. You can watch that video. It's a 20-minute video. Each of these parameters is discussed in detail with examples. And I have shown on MarketSmith how to implement this filter. On top of this, you add this overlay screen. Okay, this is for positional traders. So when you buy a stock, how do you decide whether you want to hold on to the stock for 6 months or 1 year? Unless the sales continue to grow, unless the earnings continue to grow, unless the margin continues to expand, it doesn't make sense to remain invested with the stock. Correct? If the fundamentals of the company are improving and the price remains above the 50-day simple moving average, only then it makes sense to keep that position. That's called positional trading. Because when you buy a stock and you decide to hold on to the stock for 6 months or 1 year or maybe 2 years, or as long as it remains above the 50-day simple moving average, if that is your strategy, then you need to have a very good reason as to why you want to hold on to that stock. Because holding on to the stock is also like taking a position, because that capital is stuck in that stock. You could invest that capital in some other stock. So you need to have a very good reason. And I want to give you the reasons in this video. Okay, so number one, accelerating sales growth. What do I mean by that? So first is growth. The sales should grow. Whatever product a company has sold in the last financial year or the last quarter, they should sell more of the product in the next quarter or the next financial year. So growth has to be there. But growth is again of two kinds: accelerating growth and decelerating growth. So for example, in the last 3 quarters, let's say the sales grow by 10%, 12%, 15%. That's called accelerating, from 10 to 12 to 15. Okay. Decelerating means the reverse. It's like 20%, then 15%, and then 10%. Okay. That is called decelerating. We don't want decelerating growth. We want accelerating sales growth. Now, when you look at quarterly sales growth, I want to compare the quarterly sales of the current quarter, last reported quarter, with the same quarter last year, and then calculate the percentage. That's the growth rate. Okay. You don't do quarter over quarter. You take one quarter and compare that number with the same quarter last year. That's the correct way of calculating quarterly growth on an annual basis. So the sales growth should be there at least for the past 3 quarters. And when you look at annual, at least for the past 3 years. Okay. If not the numbers, if not the percentages, at least the numbers should grow. And I will show you an example. So the strict criteria is about the quarterly. And as far as annual is concerned, well, it's okay. Even if the numbers are growing percentage wise, even if it is not growing as much, it is okay. But at least the numbers should grow. The top line should grow. Okay. So 3 quarters, 3 consecutive quarters of accelerating sales growth, 3 years of sales growth. Same applies to earnings. 3 consecutive quarters of accelerating earnings growth. Okay, you could take EPS, you could take net profit. It's one and the same thing. Okay, then last 3 years of earnings. Okay, should be growing. Okay, or last 5, 6 years. If you see the earnings, there should be growth in earnings. What about margin? Margin is basically the net profit margin. Now you have all sorts of companies where margins range from 3% of sales to about 75% of sales. So all kinds of companies are available. The number is not important. What is important is whether the margin is expanding. 5 years ago, if the company was making a profit margin of 10%, currently, is it making more than 10%? Okay, that's called margin expansion. Return on equity, well, the net profit divided by the shareholders' equity, that number should be more than or equal to 17%. This comes directly from William O'Neill's book, where he has studied stock market here history of more than 125 years. And then he came up with the conclusion that 17% is the optimum number. Okay. So return on equity, we directly have the formula given by William O'Neill, which is well researched. Okay, for growth stocks. And by the way, we are only discussing growth stock trading. Okay, this is not growth stock investing. I am talking about growth stock trading for positional traders. Okay, it's very different from swing trading. It's also very different from investing. Okay, investing can have growth stock investing and value stock investing. Here I am specifically talking about growth stocks, stocks which are showing explosive earnings and sales growth, margin expansion, and high return on equity. And you are holding them as a positional trader because you also have looked at technical factors. So you are combining technicals and fundamentals and then deciding to take a position in the stock. And you want to stay with the stock as long as the underlying fundamentals remain strong. So now let us look at an example. So this is computer age management services. This is an example from the Indian market. So if I open this, I click on consolidated. See, this is quarterly earnings, EPS growth. Okay. 17, 20, 38, 41. This is called as accelerating earnings growth. Okay. Imagine if this was 41, 38, 20, and 10. That is called decelerating. We don't want that. We want accelerating. So this is from September 2023, December, March, June. It is accelerating. Similarly, quarterly sales 2%, 10, 13, 19, 25, 27. Can you see it is accelerating sales growth? So we looked at sales, we looked at earnings on a quarterly basis. Now let us look at on an annual basis. Look at this. This is annual EPS. Okay. 2017, what was the EPS? 21.51 rupees. 2024, it is 72.06. So it has more than tripled in 6 years. That's nice earnings per share growth. Okay. That's what we want to see. I don't want to see year after year, but see in 6 years, it has more than tripled earnings per share. That is fantastic. Now, annual sales. We looked at quarterly earnings. We looked at quarterly sales. We looked at annual earnings. Now we will look at annual sales. So you scroll down. Annual income statement, revenue from operations, total operating revenues. See, 18, and 24. So this is annual. 641, 693, 699, 705, 909, 971, 1136. There are no percentages here, but can you see the trend? Is it increasing or decreasing? It is increasing every year. Every year, the company is selling more product or more service. Okay. That's exactly what we want. So, again, let me repeat. We have sales growth, we have earnings growth, we have accelerating sales growth for the latest 5 quarters, we have accelerating earnings growth for the latest 4 quarters. Our minimum requirement is 3. Plus, even on annual basis, sales is consistently on the rise. Earnings has tripled in 6 years. Now let us look at margin expansion. For margin, see, go to ratios, after tax margin. Look at this. In 2012, the margin was 18.53%. Now it is 30.88%. Has the margin expanded? Of course, the margin has expanded. So you see how simple this is. Then last criteria, return on equity 17% or more. Return on equity, see, 39%, much beyond 17%. So this is what I am looking for: accelerating sales growth, accelerating earnings growth, expansion of margin, and high return on equity. These are the characteristics that we want to look for. Now, not every company will have all of these characteristics coming together like it has come in this company. Sometimes you will have sales and earnings in your favor, but the return on equity is poor. Sometimes you will have return on equity in your favor, margin expansion is there, sales are there, but earnings are not there. So you have to be flexible enough. To what are you giving more weightage? My weightage criteria is like this. My first priority is earnings, second priority is sales, third is margin expansion, and fourth is return on equity. If I have, let's say, sales and margin expansion, but no return on equity, no earnings, then I might not take the trade because earnings have to be there. Okay. So this is how I look at the fundamentals of a stock. Because I am a trader, I don't have time to read the entire balance sheet or the annual report of a company. So what I do is, first thing I do is, this is very simple. First thing I look for these criteria. This doesn't take much time. Then I look at this. Again, this doesn't take much time. Then what I do is, there are other YouTube channels where if I want to know more about the business, there are other YouTube channels where the business is discussed in some detail. If I spend 10 minutes just watching a video which explains the business model of the company that I just showed you, then I get a very good idea of what the business model of the company is. I have a very good idea of the fundamental numbers. I have a very good idea of the technical factors that are setting up. Okay. Considering all of this information, I then take a position in the stock. So it is not some random guess. It is not some gamble. Okay. I am looking at technicals. I am looking at fundamentals. I am watching a YouTube video where the business model of the company is explained, not necessarily the numbers. The model, how does the company actually make money? Who are the customers? Who are the suppliers? What is the main driver of uh, of income for the company? If I just know all of this information and there is a tight base on the right side which sets up a proper buy point or the pivot point, and if I'm not buying a late stage base, then that's an educated decision for me. Even if that position hits my stop loss, I wouldn't mind because I did my research. Okay. I did everything I could do before taking the position. So if you put this much thought into every single position you take, don't you think that it will have a meaningful impact on your trading performance? On top of this, when you add the concepts of risk management, where the price tries to break out of your uh, pivot point, but you don't get price follow through and volume follow through, you quickly get out of the trade. Okay, that's a part of risk management. On top of all these technical and fundamentals, when you add risk management, it really adds to your performance. But when the price starts to go in the direction that you are anticipating it to go, that means the market is validating your opinion. Okay. And when the market is validating your opinion, do not sell the stock, because that is the result of your hard work, right? You did all your hard work, and then the market is saying yes, your work was in the right direction, the price is going in the direction, volume is coming, institutions are buying. The market will not give you a reason to sell the stock. Okay. So this is about positional trading, and we are talking only about growth stocks here, not value stocks, because this criteria is only applicable for growth stocks. Value stock investing is a entirely different field. So use these filters. It will help you in your trading. Okay. And please don't forget to like, comment, and share this video, so that I want this video to reach as many people as it can. uh, those who want to become professional traders. There are people who want to become professional stock traders. Okay. A lot of people are burning their money in derivatives and futures and options. This is plain and simple, old school buying and selling of stocks. Nothing can be more easier than this. I want this video to reach retail traders, where they can apply some basic concepts in the market and do some old school buying and selling of stocks with proper risk management. So for that, I need your support. So please like, comment, and share this video, so that this video reaches like-minded people like you, who truly want to become professional and profitable stock traders. So I need your support in this. Thank you so much.